Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. December corn posted a significant low as it rolled into month end, and it appears that traders were looking to take profits after a significant rundown in the market itself. We ran some numbers for you and wanted to show some of the reasons why this potential low may be of minor significance. Starting from the major high that started way back in July and the first drop down into that significant low, we took and casted that measurement and found that an extension of that measurement starting from the next major high, a 1.618 extension of that movement landed at 349.5. We also extended down to about 1.786, and that gave us a specific range at which a wave 3 low could in fact occur for this movement, suggesting that we are now in the midst of a wave 4 consolidation before one more final leg down in this corn movement. We currently have overhead resistance potentially sitting at 373 3/4, and this is just above where the market is right now. And our anticipation is that the market would find good resistance somewhere near this zone, perhaps as high as 365, and at which point we would be looking for one more leg down where the market could look to move and perhaps test somewhere in the neighborhood of 325 to 335. Upon doing so, we believe that mid-September, whether or not the market's able to make it down to this area, would signify a potential for the contract low, at which point we would start looking for indications for corn to start making its way back up. We did have a time factor demarcation for this contract sitting at about September 5th. The market has moved up into this area, but it's only been about 2 or 3 days up from the previous low. Additionally, we had talked about how a potential low could find itself near 344.5, and that's very much exactly where the market did come in before making a nice reversal back to the upside. We talked about resistance overhead being at 363. We also have a 270-degree price factor above at that level that can prove to be of minor resistance for this market. Once this potential consolidation exhausts itself, we would be looking for the next leg down. And again, we like that number near 335 for a potential final low for this December contract. These last couple of days have found soybean futures in a position where it is unusually strong. We see a very nice move to the upside over the last 3 to 4 days. And in a similar fashion to corn, we took a measurement off the previous major low up to the next major high, and then back down to the previous low and took an expansion of that initial range. A 1.618 expansion of that range puts us at 979.25, and moving all the way up to 1.786 puts us at 984. This range then becomes a very important zone where this market could potentially find good resistance. If it were to break through this area, we could see the market perhaps trade its way up to about 995 or so, but we do believe that right in the area of 980 to 985 should prove to be very good resistance. Despite the strength that we've seen over the past couple of days, we continue to believe that soybean has one more significant leg down before really putting in a significant bottom. But the one caveat that we do want to mention is the unusual strength in activity that we have seen in soybean oil contracts. The strength in soybean oil could serve as a catalyst that helps to stabilize prices and in turn keep soybean futures from going down as much as we initially anticipated. From this vantage point, we can see that the fib expansion area of 1.618 to 1786 is a direct overlap right on top of our 180-degree price factor of 983.25. And so again, we do believe that the market can find itself in a position where we're finally going to see some exhaustion of the recent advance that we've seen. The market currently is also sitting right in the midst of volatility-based resistance overhead, which has its region between 971 and 987. And so again, we believe that this market then could very well find itself in a space where it could exhaust for some time. In the event that it does find strength to break through, we do like that $9.95 to $10 mark overhead. at which point the market would probably find itself struggling to get much higher than 10, as we'd see several sellers coming in to take advantage of that price level. At this point, we do believe that a correction is due soon for the soybean futures. In doing so, the market can find itself coming back down. And long term, we're looking for a retest of previous lows at a minimum, and for the market to perhaps test somewhere in the neighborhood of 890 to 900. Moving on to December wheat, we're really liking what we are seeing here. Previously, we had discussed a minimum price objective of 424 for this contract. Part of how we were able to come up with that target was using the radial swing of a scaled chart that we've discussed in the past. What we did here was we took the center of this circle, using the very high that the market had made, coming down to this major previous low, and then taking that move and simply swinging the chart from this movement and giving us the tangent of that low gave us our price objective of 424. And once the market was able to hit this price threshold of 424, we can see now that the market has been incrementally making its way up from that level. This low then we know to be of low significance, and that price range for that target we're looking for was somewhere in the neighborhood of 397.75 to 424. It hit the top end of that actual target range, and the market has since been moving up from there. We're currently sitting right up against one of our point of control thresholds near 445, and if the market's able to break through above this number, we believe we should have some good resistance, probably sitting around 455. We do have a time factor coming in for this market on September 20th. The near-term time factor that we had actually did sit at September 5th, and so the market could very well find itself plus or minus a couple days either side of finding a top near that September 5th date. We can see that September 5th timeline coming in right at the end of the shaded area of the chart, and we do have the potential for very good resistance overhead at 455 as discussed just a moment ago. Potentially then we're looking for the market to perhaps edge its way higher over the next couple of days, perhaps reaching that 455 zone. If the market then finds weakness or resistance there and then turns back down, we would look then for the market to turn down at least through the 20th or so. Keep in mind that September 20th is an important time factor on many indicators for us, one of which is the autumn equinox that is on the horizon. We anticipate that getting much higher than 455.25 will be very difficult for the December wheat contract, and once the market starts to make its way back down, we would have a price objective somewhere in the neighborhood of 413.5, which sits at our 360-degree mark. That comes in at a cycle termination point for this contract, and we believe that this could be the low of significance going forward for this December contract. The move in crude oil futures has been very impressive, to say the least. Several weeks back, we shared with you that we believed that this low that came in back in June was perhaps a low that was going to stand for some time in the event that the market was able to hold itself up against some key important levels. From there, the market was able to make an advance, and the next key threshold that we discussed was the $51 mark. The first time that the market moved up to try to test this area, it could not quite get above that number. It then gave us a pullback, and that pullback did retrace somewhere in the neighborhood of 50 to 61.8%. That 50 to 62% range is a Fibonacci range, and as you can see, the market tested this area twice. The first time it bounced up, wasn't quite able to get back above the 51 number, gave us one more retest, and that last retest happened to coincide with one of our natural sinusoidal waves. We do have a 120-degree factor just below, but the market didn't quite make it that low. The market has since been moving back up and is now poised to retest that 51 mark that we had discussed previously. Needless to say that we were unaware of Hurricane Harvey at the time when we suggested that the market was making a low of significance. Not only do we have Hurricane Harvey behind us, we now have Hurricane Irma on the horizon, and because of that, the market is seeing a bit of jitters, and with that, the market has found support right at our Fibonacci threshold of 47 to 47 and change, and the market has been moving up from there. Over the course of the next couple of days, if this market's able to post a couple closes above that 51 mark, we would then believe that the potential of reaching a target threshold in the neighborhood of 52.80 and possibly as high as 54.75 would be probable. Upon doing so, the market would potentially find significant resistance, and at which point it could turn back from there. I do want to point out that we do have volatility-based resistance moving down, which could add some pressure for the market. So getting through this 51 mark is going to be very important for this December contract in particular. In light of the recent events in Texas because of the storm, we now find that cotton has not only reached our minimum price objective, it has exceeded the next level and hit the next target of 74.24 that we had talked about. And you can see with today's movement, after hitting that number, the market has found a bit of resistance. According to the news wires from yesterday, the massive move that it did post was in part because of jitters from Hurricane Irma that is on its way to hit the Caribbean and parts of the East Coast potentially. And so from here, we can see that the market is poised to potentially consolidate a bit depending on what we see from the upcoming hurricane. The market has hit our price thresholds. Consolidation right now is probable, but it is still possible that the market can continue higher. The way in which this market has run up has been consistent with price movement. We saw a very nice continuation pattern for this market. We had a nice leg up into this movement, and it has far exceeded the move on the other side. And so now the market is up against resistance. And once again, that resistance is right at 2 standard deviations above our point of control. The explosive move that we see is in line with our time factor of August 30th. And you can see from here that the market was essentially giving us that continuation pattern. Once that August 30th date hit, the market then began to explode to the upside. And that's the point at which we really saw some of the strength come into this market. In the event that you've taken advantage of going long this market and have been able to profit, we do think it would be well advised to take profits in this area and at the very least adjusting stops up in the event that the market's able to continue higher. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.